Welcome, everybody, to this evening's Solving the Retirement Puzzle webinar. A lot of folks on the line, a lot of interest right now in folks managing their risk in retirement, maximizing their Social Security benefits, managing tax liability, which is significant and only going to get worse. Again, my name is Jim Jolly, and we are going to cover a number of topics this evening, and I'm really excited about it. A lot of folks on the line, as I'd mentioned, and the reason is there's a desperate need for advice right now. So that said, we are going to get going here, and we'll talk about some of the ways that clients just like yourself are benefiting from some of the sell-offs in the market and some of the new legislation that has recently been passed. So I imagine many of you have been affected, if not personally, you know, family and friends that have. We see that firsthand all over town here. I'm in East Greenwich, broadcasting from our offices right down on Main Street. So again, my name is Jim Jolly, and I'm an independent registered financial advisor, and I clear through three firms, one being Raymond James, one is Bank New York Mellon, and that's Pershing, and the other choice we have is Fidelity. So a lot of flexibility, again, independent financial advisor, and we're here to provide information and help for you. So as far as personally, I've been affected, right? Can't go to the movies, certainly can't go to your favorite restaurants, can't get a haircut. You know, kids are quarantined at home, driving everybody bananas. But I must say, on a professional basis, business has never been better. So we have been thriving in here and busy around the clock. And the reason is because, as I alluded to, people want answers, right? So if you have a retirement plan, are you confident enough to get a second opinion? I think it's a great time to do so. If you don't, you need one. And we're going to talk about some of the ways that you can manage your way right through this coronavirus. My goal personally and professionally is to come out of this better than I went in, learn more, and be a better advisor, helping more folks out there. And we're going to arm you with ideas and strategies so you can come out of this better than you went in. So that being said, I am a registered independent investment advisor, and we're going to help you solve the retirement puzzle this evening. So when I say an independent registered financial advisor, I do mean a fiduciary, right? A fiduciary has your best interests in mind. And I've been doing this right here in East Greenwich for a great majority of my career. So I graduated from the University of Connecticut with a business degree. I studied finance there and graduated in 1991. Also ran cross country and track there. And when I graduated from business school, I started in the investment business with a Wall Street-based firm. And that firm had a local office, and that was right here in East Greenwich, and I'm still here. And as you can imagine, many of the businesses, many of the folks that are clients and really good friends are unfortunately been impacted by the cessation of the economy, right? The shutdown of the economy, not only here, but around the world. So we want to help you. We're helping our clients day in, day out, and we also want to help the community. So at the tail end of this meeting, you'll have an opportunity to book or schedule some time with us, about a 20-minute or so Zoom or webinar or conference call, or just a phone call if you'd like, to get to know you better, to see if we can be of help to you. And for those folks that do, we're going to try to, again, help the community, help those who are struggling to keep their doors open. And we're going to give you a $25 gift card to a restaurant of your choice right down here on Main Street. So a lot of great places to eat. And so we're going to do our little part. Might not be a game changer for some of these folks, but again, we're going to try to help out and do our part. And that's certainly with your help as well. So with that, we're going to kind of jump right in here. But I do want to say that I am convinced that the massive amount of market volatility that we've seen, and additionally the price dislocations, has created a lot of opportunities. In addition, we've seen this $2+ trillion stimulus act come out of Washington recently, signed into law. That has created a lot of opportunities for folks too. So we're going to talk about that, and we're going to give you the best ideas. We're going to talk about that, of course, at a higher level, because we can't get too granular. We've got a lot of folks on the call, as I mentioned. All those folks have different pieces of their puzzle, so their puzzles are going to look different. So we'll save all those particulars, if you have Social Security questions or retirement income planning questions, for a meeting for those one-on-ones that we do. So that said, never more an important time to be on the call. So thank you again. We're going to dive right in. But I'd like to preface by saying you're all in the retirement red zone, right? So we're in a critical point right now where we are leading up to retirement. If I could use that football analogy, the retirement red zone just simply means can't fumble, right? There are no do-overs in retirement. And as well, we want to make sure we put that ball in the end zone. So we're going to get our 35, 40-minute presentation going here in just a few minutes. And again, the idea behind setting some time aside is to get to know you a little bit better. So we'll ask some questions, see where you are, identify where you want to be, and then help build that roadmap to get you from where you are today to where you want to be. So it'll give me an opportunity to kind of find out a little bit more about you, and equally important, if not more important, it'll give you an opportunity to find out a little bit more about me and our practice here and how we serve our clients. So and at any point in that process that you think we can't add significant value to your bottom line, to your retirement, then no is always an appropriate answer. If you say, hey, this is working, I think you guys can help us, then by all means, we'll continue this virtual meeting process until you guys get all the answers that you need. So that being said, retirement looks well different than it did just a few weeks ago, right? So we have had a tremendous amount of volatility. We are going to go from likely a near all-time low in unemployment to what amounts to a near all-time high, likely, in unemployment, and all within just a few months. So this is unprecedented times, as I had mentioned, but what we need to do in unprecedented times, right? If we're dealt the lemons, we're going to make lemonade with that. So there are some great opportunities, as I'd mentioned, that we're going to share with you. And the next slide is actually, we are not getting Zoom bombed here. That's my face on Joe Exotic. So a lot of people watching Netflix, and boy, has that stock done well. People doing puzzles and reading books, and I'm going to ask you to put all that stuff away for a little bit, right? So we are going to give you some ideas to make money, right? So this is an exciting time in my business because we can help. So with that, we're going to start with Social Security. And why Social Security? Because it impacts everybody, right? Everybody has Social Security. Everybody pays into Social Security. And just like building a puzzle, right? Social Security is the cornerstone. And when you're building a puzzle, you're usually going to start with the corners and the edges, right? So that's why we talk about Social Security, a little bit of history. FDR signed into law in August of 1935, Social Security, and that's just to help folks have additional retirement income, right? An income that continues after they retire at age 65. The very first person to draw Social Security was one Ida Mae Fuller. Ida was born in 1875, and she lived to a ripe 100, which is amazing back then, right? She drew Social Security for almost 40 years. She started drawing at 62. Ida paid into Social Security nearly $25, as you can see, $24.75 in total. Her first check was $22.54 she drew nearly $23,000 in total. So it was certainly a wonderful investment for Ida. That being the case, we're going to talk about at some of the basics here. So age 62, that's the minimum age you can start to draw on Social Security. Of course, there's disability and there's also death. So in those cases, one can draw Social Security as early as 60. But for most folks, 62 or full retirement age, that's FRA, is 66 or 67 for a lot of the people that are on the line tonight. Now, you can wait certainly to age 70. That's your maximum filing age. And each year you wait, you'll gain 8%. And that does not include the cost of living adjustments. Now, the COLAs have been since 75, 3.69%, last 20 years, 2.15, and you see last year, many of you well be aware of, 1.6%. So that's just more reflective of the low inflation environment. It's also reflective of the fact that Social Security is in need of additional assets. As a matter of fact, Social Security needed to go into the trust to pull out assets, meaning there's less money coming into Social Security than going out, right? So there's ways that Social Security Administration can manage this. One is they can, obviously the cost of living adjustment can be lower. Second is the Social Security wage tax can go up, right? So more people paying more dollars ultimately into Social Security. And last year it increased by about $5,000. So the maximum benefit, if you maxed out your income each and every year, so if you hit the wage tax max each and every year or more, $3,011 a month. And the average married is $2,531, and for a single individual, just a little over $1,500. So another big part of Social Security is this Budget Act that was passed in 2015. You'll see some changes there. And I say this is why it's essential to get a Social Security maximization report. And this is what we will do for all the callers in the line. So if you provide particulars, we'll coordinate that with the rest of retirement assets and do an analysis and then get you back a report. We'll be taking a look at that report in just a few minutes. So the disability Social Security is now funded through 2022. File and suspend strategy has been canceled, right? So no do-overs there, and restricted applications. There are no changes to survivor benefits, but it's not available to folks filing after January 1st of this year. So those are that was a major piece of legislation, and that's why it's critical, because this is a moving target, right? So if you had a retirement plan, maybe a handful, 7-10 years ago, you did one. It's important because not only is your situation changes, the markets change, but legislation around these plans change too. So it's important to look at that, especially now. So why is planning so important? Here's an example. There's a couple here, Ron and Nancy, and Ron's 60, Nancy's 58, and they come into our office. It's hypothetical, of course, but they look at Social Security and they see some numbers in front of them, right? So their maximum benefit, $30.11 for Ron, $22.35 for Nancy, and this is at age 62. However, they're looking at $1.6 million. It's a lot of money. It's intriguing to them, but we counsel them and say, well, you might want to consider full retirement age. And so the total benefit, assuming a 2% cost of living adjustment, is now from 1.6 million to 1.9 million, right? So almost a $300,000 difference by just waiting a few years. Now we're assuming that Ron lives to 85 and Nancy to 90, right? But then after we run a Social Security maximization report, we show them that they could take in a $2.1 million if they waited till full retirement benefits. That's age 70. So for them, We waited, and they put in, well, nearly $466,000, as you can see here, more dollars in their pocket over the time. So get your customized Social Security report. A little bit of planning goes a long way here. And again, there are no do-overs. So Social Security, a lot of nuances. Come get a report. Will help you make the right decision. Also, taxation in retirement. We're going to talk about historical tax rates and where they are right now. This is a big piece of your retirement, keeping more of what you earn. Also, where are taxes going from here, right? Roth conversions, some great strategies and ideas there that I think a lot of you will want to implement. And then also required minimum distribution planning. There's been some recent legislation which has changed the landscape there. So that being the case, let's go and we'll take a look. So here's the national debt levels. As you can see on the chart here, debt has gone up and gone up dramatically, right? So 1970, debt $371 billion. Today, north of $23 trillion, right? So we've seen a jump here. And if you take a look at the multi-trillion-dollar stimulus package that was just put forth, signed into law, that's going to only add, right? So where's that money coming from, and who will fund that going down the road? So take a look at historical tax rates. This is a real interesting chart. I often say a picture's worth 1,000 words, and this will tell you that historically federal tax rates were well higher. They are now well lower, but with this debt growing and having the lowest tax rates nearly in history and having the highest federal debt, it doesn't take a genius to tell where tax rates are going in the future. So this is important because we need to plan, right? So people don't plan to fail, they fail to plan. So we're looking out and we're making informed, educated decisions based on the facts of what's happening today and where we think things are going. So I run into a lot of advisors through prospective clients and clients that I work with, and a lot of folks are shook. A lot of advisors are recommending maybe just sit on your hands, maybe don't do anything. Maybe that's the best strategy. But I tend to feel that being an ostrich in times like this is not the right strategy. I think we need to really dive in. This is a time to get granular, dive into the portfolio, look at your situation not only now, but going forward into retirement, and then utilize some of these programs that are in some of this recent legislation that's been passed, and try to use that to your advantage, because there's some great strategies out there. So that being the case, take a look at the financial accounts that you have, and most of those tend to be, the bigger assets tend to be qualified accounts, right? 5.7 trillion now in employer-sponsored 401k plans. So, back when I joined the business, it was less than 10%. Right now, it's less than 10% in pension plans, right? So less than 10% of the population here in America has a pension. But it was about 85 or so percent back in '91 when I joined the business. So people worked long periods of time for one company. They had pensions, and that pension would be a life income. Well, that's not the case, right? The retirement onus in growing your assets is almost entirely on you. So you'll have to do it alone. Limited investment options in many cases with the 401ks and like plans. And there are very few safe investment options. So we gear our clients, we help them pick their investments. We'll work with them closely to help them make sure they're in the right places based on their lifestyle, based on where they are with relation to how many years they have in retirement, what their risk tolerances are. So it's difficult to do this all yourself, and that's why, frankly, we've been real busy. So the Secure Act is recently passed. That's a few months ago, right? So this is something that we didn't know about it, right? We didn't vote for it, but it's law, right? And it's something that it's part of our reality now. So this was part of a larger bill, and some of those measures are that we have now pushed as a country the required minimum distribution. So you've got to start taking RMDs. Typically, it's been 70 and a half. Now it is now 72 years of age, right? So the percentage hasn't changed. It's just you don't have to take money out of your qualified retirement vehicles until 72. So that is just addressing some of the longevity issues. And we'll talk about that a little bit more in detail as we go along here. But that's addressing some of the longevity issue. People are living longer, and the concern for the government is more people outliving their retirement resources means more people on Medicaid, right? So more people on the government dole, so to speak, and they want to eliminate that. So they giving folks a longer a time to grow those assets without having to take them out. So the other part of the Secure Act that I think was significant was the stretch IRA for non-spousal beneficiaries has been done away with. What does that mean? That means that if you leave your IRA to anybody but your spouse, that individual will have to reduce that account by approximately 10% a year. In other words, they'll have to take the entire account out within 10 years of the year of passing. So the days of having an IRA stretch from generation to generation are behind us. So we've got to prepare for that too. So it's a great time to check beneficiary designations and address some of those concerns before they really are big problems. Also, retirement age limits. There are no more. So if somebody wants to contribute to an IRA and they're 74, they can do that. That's, again, people are working longer. People are living longer. They're living healthier lives. We've got clients that work for the love of work, and they're in their 70s into their 80s. So we're seeing that more and more, and that's a response from the federal government to people wanting to add to retirement accounts later in life. Automatic enrollment for 401ks from 10 to 15%, and also the use of annuities in qualified plans, an option so people can have lifetime incomes with the assets that have generated. Some of those lifetime incomes, for those who have longevity in their family, it certainly makes sense. So RMDs, like I said, now it's from 70 and a half to 72, but also, if you don't take your RMD, because, investment company doesn't call you up and say, hey, Mary, make sure you take your RMD. It's imperative that you do so. A lot of times that call doesn't happen, right? So if you don't, if you've got to take out $10,000 next year and you fail to do so, the taxes are $5,000, right? 50% of the amount that you should have taken goes directly to Uncle Sam. So you'll want to make sure that you're taking that RMD, and you want to make sure that that required minimum distribution is part of your overall retirement income plan. So we do forecasting models. We put all the pieces of your retirement puzzle together to make sure that you're taking money from the most efficient areas, right? The most effective areas, minimizing your taxes and maximizing the dollar home. So we'll run that analysis for you, and we'll give you an opportunity to get in a one-on-one so we can discuss some of those particulars. But at 72, it's almost 4%, what you got to take out of your retirement accounts. At 90, almost 9%, right? So as longevity shortens, you've got to take more money out, of course. So that's the IRS wanting to get that tax-deferred money out, right? So kicking the can down the road, that's what they're doing. Where do you think tax rates are going? Well, if I had a meeting like we normally conduct these workshops in restaurants and places of the such, we'll put up hands, and an overwhelming majority of folks will say taxes are going up. And if you really look at the situation today, I think very few people would think that taxes would be going down. So what are our options, right? We can do nothing. We can continue to kick the can down the road, as I mentioned, right? Defer dollars. But that can be a tax torpedo, and we'll talk about that, right? The tax torpedo especially can affect the taxability of your Social Security, right? So we want to not be ostriches right now. We want to proactively look at all the pieces and put those together. So you can certainly pay taxes now, withdraw, right? Which is a known, right? You know the tax rates today, or you can do tax efficient planning options, right? So we'll look at these different tax efficient planning options, and then we're going to see which ones work for you. Of course, they may not all work for you, but it's good to address it. And especially, there's no better time than right now. So converting to a Roth IRA, does it make sense for you? Well, I know for a lot of clients, especially those who don't have to take an RMD this year, right? Part of the Secure Act, no RMDs at all in 2020. So if they had to take out $30,000 out of their IRA, does it make sense to take $30,000 out of a qualified plan out of their IRA and convert that to a Roth IRA when the markets are lower? Ideally, we think it does. And the reason is because then those dollars can grow tax-free, right? When the markets do come back, those dollars are tax-free. And if they took $30,000 out last year out of their IRA, they're not increasing their tax liability, right? No RMD this year. So that same amount of money they would have to take, they're just going to put it in Roth. Makes a lot of sense. So we can work with you to do Roth conversions for sure. So pay taxes at today's rate. Don't continue to kick the can down the road. That works for a lot of folks. Also, living benefit plans, right? This is tax code section 7702, if you can see that. A lot of flexibility here. Contributions are tax deferred. They're not pre-tax, but they're tax deferred. Gains are locked in annually. You've got principal protection if you want. You've got critical and long-term care provisions. Very, very important. Tax-free retirement income for folks who take advantage of these plans. And also no IRS age restrictions here, right? So a lot of my clients that have accumulated monies love that. They're a little older and they have different ideas. Maybe they want to give that to a charitable organization. Maybe they want to pass it to another generation. So 7702, the IRS tax code, makes a lot of sense for a lot of people. So bottom line is get your tax efficient plan, right? This is, if it can save you 10, 15, 20% a year, that's real dollars in your pocket, right? So do what we love the fact that taxes are lower. That's the known. Taxes down the road, that's the unknown. So we're going to identify your unique circumstances and then build a plan around that. I also put in some information about the CARES Act. Now, I could do an entire webinar just on the CARES Act. Why? Because it's a lot. It's multi pages, a lot of particulars, a lot of detail. And but I just want to touch on some of the highlights here. CARES Act, that stands for Coronavirus Aid, Relief, and Economic Stimulus. The PPP has the Paycheck Protection Plan that you guys have become familiar with in the news. Small business tax relief is helping folks, albeit slower than most had expected. There's a number of business tax provisions. Tax filing deadlines have been postponed to July 15th. Unemployment assistance is there, right? So we've got a boost there. Checks to individuals, $1,200, $2,400. There's benefits for minor children. Also educational provisions have been part of the Stimulus Act. Healthcare, Medicare, Medicaid, we've seen it all. It's all kind of wrapped up in this one massive bill. Likely this will exceed well more than $2 trillion. So, but obviously the details are it's a fluid situation. So we'll be adding to this as needed. But really what I wanted to spend a couple of minutes on is the retirement part of this. And that is that if you have emergencies, COVID related, you can take out $100,000 out of your IRA retirement account, and you can pay that back over 3 years. And there's no tax penalty if you're 59 and a half or younger. So that could be beneficial to some folks on the call. Also, loans up to $100,000 from qualified plans. So places of business have a 401k or light plan. You can get up to $100,000 out of those plans. And as I mentioned earlier, no RMDs in 2020. So that's big, right? And that's a game changer right there for a lot of folks. Because your required minimum distributions are built on the year-end values, so that'd be December 31st last year, that was a much higher number for folks. And then, with the markets drop, the Treasury doesn't want to see people taking money out at a low price based on a higher price and having to pay taxes on that. So I think that makes a lot of sense to help people. And it's certainly helping a lot of my clients right now. So history of bear markets, we're going to talk about it. We were in one, right? Market went over 30% down from top to bottom, bounced back a bit. Now we're seeing the markets kind of absorb some of the grim news that's coming out of corporate America. It's been a tough time, and I think we're just starting to see the beginning of that cycle, right? Earnings are going to disappoint for multiple quarters, and some businesses will come back a little quicker, but it's going to take time. And to think that this volatility is behind us and the market's going to bounce right back, I think that's foolish. So let's talk about that again, addressing your particular needs. Everybody's in a different situation. Some people have terrific risk tolerances, and some people would prefer not to see the volatility and the turbulence in their portfolios. So we have portfolios of all shapes and sizes, and we can help you and design those retirement income plans so it is comfortable to you and it gets you the income that you need in retirement. So I like to quote one of our famed investors from our times, Warren Buffett, of course, and he talks about the rules of investing, right? First rule of investing is to not lose money. The second rule of investing is to not forget the first rule. So it's important because the mathematics of loss are such that we have to make a lot more to get money back, right? So the percentage has to be greater. And we'll talk about that in a second. But this slide here shows bear markets, and these are bear markets from 1929 to the present, right? So not including the bear market that we happen to find ourselves in, but there's been 25 bear markets. It's defined by a 20% loss or more. And those happen every 3.5 years or so, right? So in a decade, we might get 2, may even get 3 bear markets. Historically, that's the case. The average bear market lasts 10 months. And the average downturn in a bear market is just about 34.5%. So we just about got there here recently. Of course, the market has bounced back, but just a quick aside. In the market debacle, the Great Recession in 2007, which market started to crack into 2008, finally bottomed in March of 2009. There were 4 bull market runs in that bear market. Those bull market runs, each of those were north of 15%. And that's what we've seen recently. I'm not saying the market's going to go all the way back to where it was just a few weeks ago, but be aware that bull market rallies in bear markets happen, right? They happen quite often. So those are head fakes. We have to be cautious, and we're certainly optimistic, but we need to place assets in the proper places to get back to good. And that's what this slide talks about, getting back to good. And we just use 30% as an example. If you lose 30% and you get 3%, right? I'm going to take it and get a 3% account. Here's it. I'm going to get that back that way. Well, it's going to take you over 12 years to do so, right? So probably not advisable. 6% will take you over 6 years to retrace and get back to even. And then now, if you get an 8% return coming out of this 30% market pullback, it would still take you over 4.5 years to get back to where you were. So what we try to do is, first and foremost, as Warren Buffett likes to say, don't lose money, right? But if we do and we are down, we need to regroup, re-strategize, and then make sure we're in the best places so those assets can come back as efficiently and as effectively as possible. So we are going to play the money game. And if we were doing this in the meeting room in the restaurant, we'd have hands going up, and it can be fun. But we're going to go through this relatively quickly because you guys all get the idea, right? So if you start off with $200,000 and you make 50%, we're just going to get silly here and say, for round numbers, you made 50% in your account. Heck of a return. So that 200,000 becomes 300,000, right? But then the next year, what must go up goes down, right? The old adage. You're looking at 300 to 150,000, right? So you're back not only to where you started, but below. Now, what if the next year you got 30% return? Now you take that 150,000 and grow it back to 195,000. So over 3 years, one would say my average return has been what? 30% over 3 years, 10%, right? But are we asking ourselves the wrong question there? And I think we are. It's not what the average return is over the period of time, or the period of years, because you've lost money. It hasn't been 10%. It's what your yield has been, what your return on investment has been. So I think that's important. It's a way to frame the discussion, especially in years where we see volatility. And I think if you come away with anything, this very next slide here, sequence of returns, is a compelling look at what the difference in returns in retirement and how that affects the overall assets. And this is why it is essential to put together a retirement income strategy, right? Here's why. Two investors. You have investor on the left, retires in 2000. Investor on the right waits a few years and retires in 2003. Now, these are the exact same returns because those years, 2000 and 2001 and 2002, are now put for investor two at the back end of their retirement. Why is that important? Because these two investors have the exact same average return, which is nearly 5%. Both investors start with $1 million. Both investors take $60,000 or 6% of the account out each and every year. Now, this is why I say, if there's a chart you remember, this is the one, right? $60,000 out each person. Person one, right, our investor to the left, runs out of money after 15 years, is out of money in 15 years. Investor two, after 18 years, going the full cycle, even with those bad 3 years tacked on the end, has $940,000. Took out $60,000 over 18 years. It is the sequence of returns in retirement that can make a massive, a critical impact into your overall retirement success. When you're moving into retirement, if you are taking money out, you need to have safe income strategies to protect against the what ifs. And that sort of highlights it, right? Their individual starts off on the wrong foot. Those are 3 bad years right in a row. And they're also taking out $60,000 a year. And that's why run out of money in year 15. So same returns, just a different sequence makes a massive, massive difference there. So that being the case, you need a portfolio analysis. You need to see what is driving the income, where the risks in the portfolio are, the expenses in the portfolio, and then make sure you have an all-weather retirement income plan. So you can see if you don't do a deep dive, you might want to find out about it 15 years into retirement, like investor one did. So a little bit of planning goes a long way. So here's the retirement risks today, or the problems, if you will. One, longevity. We're living longer lives. We're living healthier lives, more active lives in retirement, and we need to plan accordingly, right? So my grandmother's going to be 100 years of age in June of this year, and she's doing well. She's healthy, a great mind, not on any medications, right? This is not something she necessarily planned for 40 years ago when she retired, but it's a reality, right? So we need to look forward. We need to get lifetime income in some cases to make sure we don't outlive our retirement resources. Also, there's fewer defined benefit plans, as I mentioned earlier. So fewer pensions, more concern. Also, healthcare risks, right? Healthcare risks going up across the board. So longevity, let's take a look at it. Today, 100 plus, 450,000 folks. Within 36 years, the estimate is over 4 million people living beyond the age of 100. That is staggering, right? So your 10 or 15 year retirement is turned to 30 years in a lot of cases. That increases your chances of outliving your savings. And that's a big, big concern for a lot of my clients. Also, fewer defined benefit plans, right? So when I had talked about this a little earlier, when I joined the business back in 1991, 85% of employees had a pension. Today, 7.5%. So we need to do a lot more work on the accumulation end to make sure your income is going to last your entire life, right? So more defined contribution, more onus on you, right? Everything is 401k, IRA, and for those the state 457s, for those nonprofit workers, it's 403bs. But the bottom line is we've got to look at those. We've got a great time to add to those plans, of course, while the market's down. But you need to assess the risks and the fees in those plans to make sure it's adequate to get you to where you need to go. So healthcare, well, of course, we're all living longer. We're living healthier, more active lifestyle. And we're demanding better healthcare, right? Whether it's disease prevalence or more specialization. How we're using healthcare is well different. So, and I think a staggering figure down bottom here, 70% of people over 65, they're going to require some sort of long-term care. And how are you planning for that, right? Do you have that contingency built into your plan? The average nursing home plan, or stay rather, is 835 days. So if 70% of the people go and it's 2.5+ years, you want to definitely identify that in your financial plan and make adjustments to not have those retirement resources go to a medical facility, go to a long-term care facility, go to assisted living facility, a nursing home. So we can help you plan there as well. So what are the challenges to the portfolio? It's too much risk. People just don't understand what's there, right? I see more people that come in and say, hey, I'm diversified. I've got 9 different investments. Well, those 9 investments are buying the same or similar companies, right? That's not diversification. Diversification is different asset class, different styles of stock picking, geographically, different types of investments, whether it be alternative investments, equities, growth investments, value styled stock picking strategies. You want to have all of these in a balanced portfolio, right? So that just, if you have everything in a handful of investments and they're buying the same stock, well, guess what? That's an overcorrelation of assets. Excessive fees, we see it. A lot of these, legacy variable annuities, fees are 3 to 4% a year. It's a drag on your performance. Also, advisory accounts, little attention to these accounts. When you add in the underlying expenses plus the fees, it's 3% or so. And so also outdated risk assessments, right? People don't know their risk budgets. They don't know what type of risks they're taking. You need to do a deeper dive, and I can't stress that enough, right? Of course, lack of communication from the advisor. We see that all the time. So what do you expect from your advisor? You got to understand your need. You got to take the time. You got to do the management here with your particulars, right? Everybody's situation, everybody's puzzle is different. We got to really drill down, see where your goals, where your objectives are, what do you want to accomplish, what does retirement look like, and then those are your needs, right? That's what we build the plan around. As fiduciaries, we put your best interests first. Certainly, advisory accounts are a great majority of what we do here. Client education, we do workshops around the state on a regular basis. So we're helping bring ideas to you because we know if we can give you the best information, the most amount of facts, the up-to-date tax information, for instance, how to benefit from these programs, laws, changes, we know you'll make better financial decisions and you'll be here with Greenwich Bay Wealth Management for the long term. And that's ultimately what we want. A written retirement plan, a written plan is great, right? And any goal we want to achieve, we want to have it down, we want to see it, we want to be held accountable to it. That's what we do for you. And then we want to review it, right? People say, oh, I had a retirement plan. Well, things have changed. Laws have changed. Your situation's changed. The market's changed. So you need to not only have a retirement plan, but that has to be reviewed on a regular basis. And a lot of the old software, quite frankly, is outdated. We use robust software. A lot of great planning materials that we have at our fingertips. Again, clearing through some of the biggest firms in the world. We have access to some of the best minds in the financial planning world. and we bring that to you. So even though we're local here in East Greenwich, we have access to the biggest and the best out there, which is fantastic for clients. So what do you do now? Well, get a hold of us, request your Social Security analysis report, make sure that you have a tax-efficient retirement plan. You've got to request a comprehensive portfolio analysis. You have no idea what to buy if you don't know what really you own, right? And a lot of times you look at a mutual fund and ETF, but what's in that mutual fund and ETF? What are the fees, right? How is the performance? What's attributed to the performance? What's pulling from the performance, right? We need to know these risk-return ratio numbers. So this is what we'll do in a deeper dive, and that's a comprehensive portfolio analysis. Additionally, schedule a complimentary review. Doesn't cost anything, right? And we're going to get you $25 to get likely it's a different restaurant than you're used to taking out from, or getting a curbside delivery, or maybe it's a delivery at your house. It's a win-win, right? So we can help out, and of course we can help you out. So again, Greenwich Bay Wealth Management, I've appreciated you attending, especially I know these are unprecedented times, but we're here for you. We're here for our clients, and we just wish you the best. We want you to stay healthy, and please get in touch with us. We're going to help make sure that all the pieces of that puzzle are put together correctly. Thank you, and you have a great night.